Arizona's economy looks stronger than ever: record construction, record in-migration, and the crown jewel, over $100 billion pouring into semiconductor manufacturing. But that boom rests on the front line of a geopolitical standoff. The United States calls it industrial policy. Beijing calls it containment. For Arizona, it's a single bet on a volatile global market, disguised as economic diversification. The numbers prove it. One foreign company alone, TSMC, is committing tens of billions to facilities outside Phoenix. Intel follows with its own expansion. Add federal subsidies from the CHIPS Act, and the state looks unstoppable. Yet beneath that optimism sits structural exposure few talk about. If the chip war intensifies, this growth engine can seize up overnight. That's the structural vulnerability we need to examine. Why Arizona? The TSMC, Phoenix Project. The choice of Arizona wasn't random. It was strategic. The Phoenix metro area offered something rare: vast open land, existing transport links, political stability, and generous tax incentives. State officials promised infrastructure upgrades and water allocations that few other regions could match. Labor costs were lower than California's, and utilities were hungry to attract industrial load. For TSMC, the logic was clear: move part of its critical production chain onto U.S. soil to reduce dependence on Taiwan's fragile security environment. The first fabrication plant, known as Fab 21, represents roughly $40 billion in commitment. Expansion plans could easily double that number. Combine this with Intel's multi-year project in Chandler, and Arizona alone accounts for more than half of all announced semiconductor investment in the United States. It transformed Phoenix into a construction powerhouse. But dependence on a single cycle-driven industry introduces heavy volatility, the same pattern that pushed Detroit from boomtown to bailout decades ago. The geopolitical imperative, U.S. CHIPS Act, and reshoring. Washington's strategic concern is simple. No advanced economy can rely on offshore fabrication controlled by potential adversaries. When global supply chains collapsed during the pandemic, the vulnerability was exposed. Semiconductors are not just for smartphones. They run defense systems, power grids, and medical devices. Losing access is a national security event. The 2022 CHIPS and Science Act responded with roughly $52 billion in federal incentives. Arizona became ground zero for that reshoring agenda. State leaders saw a double dividend: national security alignment plus economic transformation. A high-tech ecosystem would replace cyclical housing as the main growth driver, but subsidies distort markets. Public money reduces immediate risk for investors, while magnifying long-term fiscal exposure for taxpayers. Once those plants are built, federal support wanes, leaving local governments with infrastructure maintenance, utility expansion, and workforce training obligations that last decades. The fiscal cushion shrinks while debt service grows. If global chip demand dips, or the U.S.-China rivalry escalates, the funding gap lands on Arizona's budget. Meanwhile, competition for skilled labor is tightening. Domestic supply of engineers and technicians lags far behind the projected need. Import restrictions on Chinese expertise complicate recruitment further. Every geopolitical escalation reverberates down to payroll costs and construction timelines. What began as industrial policy is now an arms race between supply capacity and political risk. China's chip ambition and the Taiwan risk. To understand Arizona's exposure, we have to examine the opponent in this equation. China spends over $100 billion annually on semiconductor imports. That dependence is viewed by Beijing as a strategic weakness. Its national response, the Made in China 2025 plan, aims for technological self-sufficiency across advanced nodes. Subsidized national champions like SMIC and YMTC are racing to close the gap, despite export restrictions from Washington. But here's the twist. Many U.S.-aligned producers still rely on Chinese materials and equipment components. China refines the majority of rare earth minerals used in chip-making tools. It dominates the mid-tier assembly and testing stages. A choke point in any of those segments can delay Arizona's fabrication output, even if every facility in Phoenix runs perfectly. Then there's Taiwan. Both TSMC's brain trust and its most advanced technology remain headquartered only 90 miles from mainland China. Any conflict scenario, even limited coercion or blockade, would instantly break global semiconductor supply. Insurance premiums, financing costs, and component lead times would rocket. For Arizona, the effect is indirect but brutal. Construction schedules freeze, imported machinery halts at port, and local job pipelines stall. Investors assume Washington will shield domestic projects from geopolitical fallout. In practice, it can't. The CHIPS Act buys factories, not immunity. If China escalates around Taiwan, Arizona's new fabs become stranded capital, high-cost facilities, waiting for unavailable lithography machines or critical chemicals. It's the same paradox that hit shale oil. National priority projects built faster than the supply infrastructure that sustains them. China knows this leverage exists. By selectively tightening export controls on gallium, germanium, or advanced tool components, it can pressure U.S. states invested heavily in fabrication. Arizona, boasting it's the semiconductor capital of America, would feel that pressure first. Semiconductor manufacturing is among the most resource-intensive industrial activities on Earth. Each fab consumes tens of millions of gallons of ultra-pure water daily and huge megawatt loads 24 hours a day. Arizona already ranks among the driest regions in the country. Lake Mead and the Colorado River allocations are shrinking yearly. That's the first structural vulnerability, the mismatch between industrial demand and ecological capacity. To offset consumption, TSMC and Intel built specialized reclamation systems, but even at 90% recovery, net draw remains massive. Municipalities must secure long-term water rights, often buying credits at premium prices or tapping aquifers faster than recharge rates allow. Those costs pass through to taxpayers. When combined with drought-driven restrictions, competition between residential, agricultural, and industrial users intensifies. That tension becomes a political fault line. Energy poses the second strain. Arizona's grid must deliver uninterrupted high-voltage power to the fabs, yet the same grid endures record heat waves and surging residential demand. Utilities now plan billion-dollar upgrades, transformers, substations, and natural gas peaker plants to keep pace. Financing those projects inflates ratepayer bills well before fabs generate sustained revenue. Infrastructure expansion is the third stressor. Roads, housing, and wastewater systems around Phoenix were never designed for this industrial scale. The labor surge adds congestion and spikes housing demand, driving prices up another 20 to 30% in nearby suburbs. That affordability crisis pushes service workers farther out, eroding the very quality of life narrative used to attract investment. All of this creates a fiscal feedback loop. Higher public works spending meets tightening water constraints and rising energy costs. When bond markets sense that mismatch, borrowing costs rise. The state's fiscal capacity narrows precisely when it should be widening to absorb volatility. Arizona's officials call the fabs a once-in-a-generation opportunity. They are, but also a once-in-a-generation liability if global demand falters or utilities misprice future capacity. Structural vulnerability means this: a single strategic shock, whether geopolitical or environmental, could turn the state's proudest achievement into its largest long-term burden. That's the reality behind the $100 billion bet. A desert state built on borrowed water and borrowed certainty, trying to anchor a global supply chain that's anything but stable. The pressure doesn't stop here. It extends into the housing market and municipal finance next. Even with the water and power secured, the real constraint in Arizona isn't infrastructure, it's people. Semiconductor fabrication requires a hybrid workforce: seasoned engineers, ultra-clean room technicians, and construction crews trained for atomic-level precision. The state simply doesn't have enough of them. Maricopa County's population boom brought service jobs, not process engineers. Importing talent from Asia or other hubs runs into visa delays, national security screenings, and cultural friction on the shop floor. TSMC's own executives publicly admitted that cross-cultural coordination slowed progress. American crews operate under safety protocols and trade union norms unfamiliar to Taiwan's managers. Communication barriers multiply errors. The result is cost inflation and schedule extensions. Reports from subcontractors suggest that meeting original 2024 production timelines is unlikely, forcing a shift well into 2025 or beyond. Meanwhile, labor shortages ripple through the rest of the economy. Housing inspectors, electricians, and municipal staff get poached by chip project contractors offering premium wages. That inflates public payroll costs and delays other construction. What was sold as high-tech job creation is, in practice, a structural labor siphon. Once subsidies fade, those inflated wages revert toward market levels, leaving households and local budgets overextended. Arizona's growth model leans on continual in-migration, but the type of migration now required engineers, PhDs, skilled technicians, isn't easily attracted by desert heat, high living costs, and limited cultural infrastructure. Building that social ecosystem takes years. This gap between capital intensity and human readiness is the second structural vulnerability, a workforce bottleneck embedded inside a global technology race. Project managers quietly acknowledge what the headlines: avoid every milestone is more expensive and later than planned. Materials, inflation, equipment backlogs, and regulatory revisions have added billions to estimated costs. Federal inspectors push for compliance with Buy American clauses, even when domestic suppliers don't exist. Each waiver request slows the schedule. TSMC already announced revised startup targets, citing labor training and tool installation complexity. This delay cascade creates political friction. Washington touts the CHIPS Act as proof of industrial renewal, while state officials wrestle with the visible lag on the ground. When ribbon cuttings produce scaffolding instead of chips, the narrative turns. Taxpayers start asking when the promised jobs and exports arrive. The longer that question remains unanswered, the faster public enthusiasm erodes. Local contractors face another pressure: price escalation clauses on multi-year deals. Cement, steel, and semiconductor-grade gases all climbed sharply in cost. Contracts signed 2 years ago are underwater today, forcing renegotiations or temporary shutdowns. Finance departments scramble to prevent cascading defaults among smaller subcontractors. In the bond market, that risk reads as uncertainty, which translates straight to higher yields on municipal debt. Add to that the political divide over foreign ownership. Some legislators question why state subsidies bankroll a company headquartered in a U.S. strategic rival's neighborhood. Others argue that excluding TSMC undermines national security goals. That argument plays well in Washington, but badly among local voters, wary of dependency on non-domestic corporations. Each controversy threatens policy stability, and corporate investors crave predictability. When rhetoric shifts from anchor investment to subsidy oversight, capital turns cautious. That sentiment cools expansion just as new phases demand commitment. The vision was bold: replace speculative housing with advanced manufacturing as the growth engine. On paper, Arizona diversified. In practice, it traded one form of volatility for another. Real estate booms rely on cheap credit and population inflow. Chip booms depend on geopolitical calm and supply chain coordination. Both are cyclical. Both devour public capacity during downturns. Look closer, and the pattern repeats. Infrastructure stretched to support suburban sprawl is now repurposed for industrial sprawl. Labor markets remain tight, housing affordability worse, and fiscal exposure higher. The Semiconductor Fund inflates short-term GDP while locking the state into federal policy dependency. Once subsidies expire, the operating costs stay. Entitlement spending meets higher debt service and stagnant tax revenue. That's fiscal compression. The larger strategic question is unavoidable. If a single adversary abroad can delay tool shipments or restrict key minerals, how sovereign is this new industrial base? Relocating fabrication from Taiwan to Phoenix reduces one geopolitical risk, while introducing another domestic fragility tied to external supply chains. The vulnerability isn't eliminated, it's domesticated. For investors and policymakers, the takeaway is discipline. Treat this boom as transitional, not transformational. Build fiscal buffers now while revenue flows are strong. Avoid over-leveraging municipal bonds on projected production that hasn't started. And recognize that long-term resilience won't come from subsidies or slogans, but from a balanced portfolio: energy, logistics, data centers, and sustainable water management alongside chips. Arizona stands at the intersection of ambition and exposure. Whether it evolves into a durable tech corridor or another cyclical cautionary tale will depend on how it manages this structural risk before the next geopolitical shock arrives.